So if you look at this question, that is question number 21 of April 2023, they are basically testing you on what we have been doing. They want you to do what? To calculate net present value. They want you to calculate internal rate of return. I don't have any doubt that all of us now are able to calculate net present value and internal rate of return. The only challenge you're going to have maybe is how do we now get the net cash flows to be used in getting the net present value. That is what we are going to look at. In some questions, they are going to give you the net present value, the net cash flows and the cost of capital. In this question, you have to calculate the net cash flows by yourself. So that's what we are basically going to do here. And we have three scenarios. We have three scenarios. So for us to understand this and now be able to do the optimistic and pessimistic scenario or case, let us do everything under expected. Let us do everything unexpected. And then from that point, I will now be able to show you how to just do adjustments and then complete everything. So for this particular project, under expected, let's just have the expected here. We are going to start with expected scenario. So under expected scenario, there are some key things here that you're going to look at. So one, we have to identify the years. All this is going to start from which year? 2024 to 2028. That's a 5-year period or 5-year project. So the first year of this particular project, is 2024. That's the first year. That is the first year of our project. Then we have up to 2028. Up to 2028. So we all know if you're going to do it in terms, so this one here will be 2023, but we all know that this one here in other terms is going to be 0. That one is going to be 0 because it is the initial period when these people are going to do the investment. When they are going to now start doing the investment. So that's how we normally do it. So for our case, we are going to do the years or even 0, 1, 2, up to 5. How did you align the columns? Which columns are you referring to? Which columns are you referring to? I think I've just shared with you the document the way it is. The document the way I have it here. So let's look at this under expected scenario. Under expected scenario, we are going to start to look at revenue, the initial investment items. So under that scenario, the first thing that you normally look for, because you don't have the net cash flows, it means there is some source of revenue. There is some revenue somewhere. So the first item that you're going to start with there will be revenue. We have revenue there. We have our revenue here. We have our revenue here. So in 2024, what was the revenue, the expected revenue in 2024? The expected revenue in 2024, we have 140. The document was shared in the WhatsApp group. It is there in our paid WhatsApp group. It is there in our paid WhatsApp group. If in that group, you'll be able to get the document. So revenue for 2024, we are given 140 million, 140 million. That's what we are given. That is what we are given. That is what we are given. Let me just make them to appear in that manner. Good. So if you have 140 million in 2024, what are they telling us that will happen to our revenue? So we have the revenue there. We have the revenue there. Then if you move down here, we have the incremental fixed cost, we have capital allowances, we have inflation rates, we have tax rate, and then now questions or additional information is provided down here. It will guide us on what the revenue amount will be in the subsequent years. We have only been given revenue for 2024. So how will we know the revenue in the subsequent years? Then automatically the additional information will help us to arrive at that. Why is in 2024 year 0? Just go. 2024, Miwani Limited plans to invest in a 5-year project in the year 2024. However, the information on the project is not reliable. The company will wish to carry out a scenario analysis. The following data is available given the 3 scenarios. So now what we are given here, in 2024, we are given the values. In 2024, we are given the values. The revenue here is received in 2024, but the initial working capital will be invested at the beginning of that year. So at the beginning of that year, that is 2024, we are having an initial investment of 100,000. But then once that year is now complete, remember what we are having here is being received at the end of the year. Our revenue for the entire year, we are going to do on our analysis at the end of it. What? At the end of that particular year. And that's why we now insert this. But the initial investment was done at the beginning of the year 2024, which means we take the beginning of the year to be 0. And that's why we have 2023 as period 0. It is now representing period 0. So let's just read the additional information and see how the items given up there will be affected. The inflation rate applies to revenue, direct costs, incremental, fixed costs, and working capital. So it automatically tells us that the inflation rate here represents the increase, the percentage increase in our items, that is revenue, direct cost, incremental fixed cost, and working capital. They are all going to increase at the same rate, which is the inflation rate. Working capital will be recovered at the end of the project. So it is automatically telling us that the working capital, of course, we are going to charge it here as an expense at period 0, that is the initial time, year 1, year 2, year 3, year 4. Then at year 5, we recover everything that was spent in the name of working capital. We are going to recover everything that was spent in the name of working capital. Then when we now move down here, the capital allowance rate is on reducing balance basis, not straight line, reducing balance basis. So you are going to get the net present value. We are not going to have a constant capital allowance. No, we are not going to have a constant capital allowance because it is on reducing balance basis. And then have we been given the rate? Have we been given the rate? Yes, the rate is given to us here as capital allowances rate is 30%. It is constant, it is not changing. It is not changing, it is constant throughout the year. Then revenue and costs arise from year 1. They are going to arise from year one. The capital allowances rate is on reducing balance basis. I think that has been mentioned. Tax will be applied on the gain or loss on disposal of the asset. The asset will be disposed at the end of the useful life or at the end of the project life. And we are going to compare the disposal value and the net present value. So if the disposal value is more than the net present value, then automatically you're going to say there's a capital gain. That capital gain is subjected to tax. Then number 5, the weighted average cost of capital for the company is 15%. This weighted average cost of capital is what we used yesterday as cost of capital, is what somebody will give you tomorrow in an exam, that required rate of return. Okay. Then compute, so we are required to do NPV and internal rate of return. So let's now come back to our revenue. So once we've been able to see this, there are some items that we are now expecting here. That depreciation, the depreciation, we expect it to be there, and it is on initial investment. The initial investment is the amount spent there. After the initial investment, are there any other expenses that were incurred to make maybe the asset ready for use? Do we have installation? Do we have freight charges? Do we have custom duty if it was imported? All those costs will be added to now help us get the initial cash, the initial cost of the asset. As per this question here, we are able to see that initial investment is not having any other costs that are related to it. So it means whatever we are going to depreciate is 100,000 for expected. But then the initial outlay is now whereby we add all the costs that were incurred to make the asset ready for use, plus working capital, So if you're going to look at the initial outlay, then working capital becomes part of that. But if you're going to look at the cost to be depreciated, the amount that you're going to depreciate, then working capital is not included in that cost. Okay, so let's now move down here. They're telling us that our revenue will be 140,000. Our revenue will be 140,000, and the revenue will be 140,000, and revenue or the inflation rate applies to revenues, direct cost, incremental, fixed cost, and working capital. So it means our revenue is going to increase by what rate? And expected by the inflation rate. That is 5%. So the revenue in 2024 is 140 million. We are going to increase it by 5% in 2025. So what will be our revenue in 2025? What will be our revenue amount in 2025? We can all remember what we did the other time. Somebody will come and say it is 1 plus 5%. Then they multiply by this. Somebody will also say, okay, it is not 1 plus 5%, it is 105%. It is 105%, then they multiply by that. And 105%, if you convert to a decimal, is 1.0, is 1.05. So whichever option that you take, you'll still be able to get your. And somebody is talking about locking. No. Why do you want to lock? And you have been told that the revenue will be increasing by 5%. If it's going to increase by 5%, our revenue in 2026, our revenue in 2026 will be 5% more than the revenue in 2025. So we don't need to lock it. I just do this, enter, then come to this point, just autofill to the very last year. Just autofill to the very last year. So we are going to have, sorry, not 1.05%. It is 1.05, so not with a percentage. If you're using 1.05, there's no percentage, unless you are using 105%. So if that is done, this is what you are going to have as your revenues for 2024 to 2028. So I just want you to confirm to me that we all have the right value for revenue. Just confirm that you have the right value for revenue. Confirm that you have the right value for revenues. Confirm that you have the right values for revenues. Good. So if that is taken care of, then let's now proceed to something else. Sasa let come as let's proceed to something else. Okay, I can see someone is talking about coming late. So this is what we have been told. This is what we have been told, that the revenue, the inflation rate applies to revenue, direct cost, incremental fixed cost, and working capital. That means the increase, the revenues, direct cost, incremental cost are going to increase at what rate? At the inflation rate, which is 5%. Now, we now come to this point here. The revenue given there and expected is 140 million. We are increasing it by 5%. So can someone give us 5% of 140 million? That is Ezra and who? Ezra and someone here should be able to give us, that is Mercy. So Mercy and Ezra should give us 5% of 140 million. 5% of 140 million. 5% of 140 million. What are we going to have? Ezra is giving us 7. So we have 140 million. And then Mercy is not giving us a figure. Mercy is letting us down. So we have 140 million. It has been increased by 5%. And you've told me that 5% is 7 million. 5% is 7 million. So if you are increasing 140 million by 5%, that is by 7 million. What will be your new revenue? Your new revenue now? Ezra, tell us something. Your new revenue. What will be your new revenue? 147. So the 147 that you are seeing is what we have here. So instead of going, you just get the summation of the two. Instead of following all this long route, we automatically come here and say equal to, let's take this one here to be 100%. 140 will be 100%. The current revenue that is supposed to be increased is taken as 100%. If I increase it by 5%, my new percentage will be 105%. That is the new revenue. So 105%, if I multiply by the current revenue, I expect to get the same figure as the new revenue here. So we are able to see all these are giving us the same figures. That is what we did at this point. That's what we did at this point. We said equal to, it is going to be increased by 105 all through. So I just come here and say 105%. I multiply by the revenue amount. So when I now autofill, it will again change. It will take 105% multiplied by this revenue. That's why I don't lock. So I was able to see somebody mentioning about locking. You don't lock at that point because you are going to keep on. We are going to change. We are going to keep on changing that. So that's why we don't lock. So that's what we have as the revenue. After revenue, remember when dealing with this, they're going to give you the cost into two categories, the variable and the fixed costs. The variable cost and the fixed cost component. So do we have the variable costs? The variable cost, of course, is direct material and direct labor as discussed in management accounting. So here, the direct cost represents the direct cost. So we are going to less direct costs. The direct cost given to us here in 2024 is 60 million. So we're going to have our 60 million. Our 60 million is the direct costs. Our 60 million is the direct. Our 60 million is the direct cost. That is in 2024. What are they telling us about the value in 2025? They are telling us here that the inflation rate applies to revenue, direct costs. So it means our direct costs also are going to increase by the same rate. They are going to increase by the same. They are going to increase by the same rate. Now, for someone who understands Excel very well, we know that we already have the formula here. They're going to increase by 5%, so 105% of the current value. What if I just come down here once I have this 600,000? I just drag it down and it automatically picks the direct cost for 2025. And the formula is already entered there, so I just autofill to the very last point. I just autofill to the very last point to get my direct costs. I think I just explained that. Somebody to help SIP. Why are we not taking the revenue value to be for year 0? Somebody to explain. Somebody to explain to SIP. Yes, it will guide you. It will guide you. It will guide you on why we are doing that. Revenue costs arise from year 1. Revenue costs arise from year 1. So that's what you're going to have. So at the beginning of the period, we invested. We have 0. We cannot receive revenue on 1st of January 2023 when that's when we are going to do our investment. You cannot do investment today and the same day you receive revenue for the whole year. No, it is not logical. That's why we have it in this manner. And even the information given to us here supports what we are actually doing. Okay, so less direct costs. And then another thing that we also have here, after direct costs, we are going to have what we call contribution. We are going to have what we call contribution. So somebody may decide to have the contribution value here. Somebody may decide to have the contribution value here. And we all know very well that contribution is revenue minus direct costs. Revenue minus direct costs. We have our contribution there. Then we are going to less incremental fixed costs. Incremental fixed costs. Incremental fixed costs. So the incremental fixed cost given to us here is 40 million. That's what we are given. The incremental fixed cost is given to us as 40 million. Then what is happening with the value of the subsequent years? It is also going to be affected by the same inflation rate of 5%. So I basically come to this point here. I have my 105%. then I multiply by the initial amount of 40 million. If that is done, I'll be able to get the values up to 2028. Then I will get my profits. So less incremental fixed cost, I'll have now operating, or we can call it profit before. We can call it profit before capital allowances. We can call it profit before capital allowances. I can see a question is there. So let's get a profit. Profit before capital allowances is the contribution less incremental fixed costs. So that is what we have as our profit before capital allowances. As our profit before capital allowances. Negate the direct cost. Okay, you can insert a negative or just work with them and then you're going to subtract. Okay. Carol is saying that I'm too fast, but these things we've been doing them. Actually, this concept of net present value, analyzing unknown figures from the revenue point. We've been doing that. You've been discussing that. It is revenue minus cost of sales, which we are now taking the only variable. That's why we call it direct. For us to get contribution, we less the fixed cost for us to get now profit before capital allowances or profit before depreciation and taxes. Profit before depreciation and taxes. Less capital guiding on how to go to get incremental fixed cost. The incremental fixed cost, it is the same procedure that we have been doing up here. What we have been told, incremental fixed cost, 40 million for the first year, that is 2024. It is going to increase here. It is going to be affected by the same inflation rate of what? 5%. It is being affected by the same inflation of 5%. So if I increase 40 million by 5%, I have 40 million given to me. I have 40 million given to me. I want to increase it by 5%. So what is 5%? What is 5% of this 40 million? It is 2 million. When I add now, because the original is this, original or initial. So original fixed cost is 40 million. We are increasing it by 5%. We are increasing it by 5%, which is giving us 2 million. Now, the new or the final fixed cost will be original plus the increase. If I add the two, I'm getting 42 million. Again, now at this other point, you are going to use that 42. You're going to use this 42 as the original. Now, it is the original in the second year. Again, increasing it by what percent? We are increasing it by 5%. We are increasing it by 5%. So I will have my 5%. I will have my 5% and then multiply by the original. What is the increase? 2100. So my new fixed cost will be the summation of the two. What am I getting? 44,100. That is the trend. That is the trend that is going here. That's the trend that we are applying to get to this particular point. That is that is what we are doing. I've never seen any link for a discussion group. Okay, that is now to be discussed in the discussion group. I believe it is always shared there. It is always shared in that group. Then, so that's the trend. Actually, that's the trend. So let's now get to this point here. We have profit before capital allowances. It means the next thing that you're supposed to have here is the next thing that you're supposed to have here is what we call the capital. Is what we call the capital allowances. The capital allowances. The capital allowances. Capital allowances is what we are going to subtract. So what are they telling us about? What are they telling us about the capital allowances? What are they telling us? Let's see the information given about that. Capital allowances rate 30%. It is going to be 30% on what? It is 30% on the cost of investment. The actual amount paid plus any other cost that was incurred to make it ready for use. And working capital is not cost that is incurred to make the asset ready for use. No, the working capital is now being incurred to do what? To facilitate or to finance the project, maybe in terms of operational costs that are going to be incurred in the process. So we now incur or bring in additional working capital. The amount we are going to depreciate does not include working capital. So it means we are interested in getting initial, the investment amount, the amount invested. So here we are going to have investment amount. The investment amount that's supposed to be depreciated, first of all, we have purchase price or purchase cost. The purchase cost is now the amount which is directly given to us here, initial investment. So the purchase cost or initial investment is given to us there as 100 million. That is what is given to us. Let me just put it down here. That is what is given to us up here. The initial investment is 100 million. Do we have any other cost? That is, do we have something to do with installment? We have something to do with installment cost? 0. Do we have anything to do with freight charges? Freight charges. Are we having anything of that kind? 0. We have transportation cost. We have transportation cost 0. Do we have custom duty if it was imported? We have custom duty charges 0. So cost of investment. Cost of investment or an asset, now we can call it an asset. We are hiding that from you. This is what we have. So at the end of the day, we've now known. At the end of the day, we've now known. I've never seen any link for. Okay, what are capital allowances in layman's term? They're basically referring to depreciation. What is the difference between straight line and reducing balance? Good. Straight line. Straight line. This is what happens with straight line. If you are told that it's going to be depreciated on straight line basis, so we first of all calculate this before we look at the method. Before we look at the method, we first of all get cost of investment. So this is the cost of that particular investment. Now, this is the initial amount or the cost of investment that are incurring to bring in the assets in place. This is the amount we are going to depreciate. Once you reach this point, you now look at the depreciation method. We now look at what we call the depreciation method. So the depreciation method that we are going to apply here, straight line is very simple. Straight line, of course, all of them are very simple. So the straight line method, it will be constant all through. If you're told that it is going to be on straight line basis, we take the cost of investment minus salvage, cost of investment minus salvage, then we divide by the useful life of the asset. So let's say that the salvage was 0. So let's say the salvage was 0. So we are going to take the cost of investment minus 0. Then the all of that we divide by the useful life of the asset, which you can say is the same as the lifespan of the project, which is 5 years. So if that is done, we could have taken this 20 million to be the capital allowance for all the 5 years of the project. That's what we could have done. If it was on straight line basis, that's what we could have done. But we have been told it is going to be on reducing balance basis. On reducing balance basis, forget about the salvage. Don't bother yourself looking for the salvage. If you're told to do it on reducing balance basis, the method here is reducing balance. So the reducing balance basis, this is what we are going to do. We now know very well that in 2024, we have our assets. So let's call it cost of investment, or we can call it an asset. The name that will be befitting to you, that maybe you cannot easily forget. The name that you cannot easily forget. So that's what you're going to apply. That is what we are going to use. So let's call it maybe cost of investment or fixed asset. Or fixed asset, let's call it that. So the cost of that asset in 2024 is this one here, cost of investment. So the cost of investment is 100 million. Depreciation or capital allowances, depreciation. The depreciation amount, we have been told, then you are going to get now the net book value. So let's get to depreciation. What is the rate for depreciation? Somebody to help us here. Depreciation rate. Profit before capital allowances. Depreciation rate. Let's say somebody might be wondering, that 30% was given to us as the tax rate. Why are we converting it to depreciation rate? Let's look at it here. The capital allowances rate is 30%. The capital allowances rate is 30%. So this 30% is what we are taking, not the 30% of tax rate, no. So we just come here. We come to our workings here and get what? Equal to 30%. Equal to 30% of what? Of the cost. We have our 30% to give us 30 million. Now, how do we get net book value? We've done FR, financial accounting. So the net book value, how do we get net book value? Cost minus depreciation, if it is on reducing balance method. So the net book value here is equivalent to cost in 2024 minus depreciation of the year to give us net book value. Now, 2025, I want my good students to tell me the value that I'm going to have there as the cost. Let's say that's now the point where we have the costs. Somebody should now help me understand this. Somebody should help me understand this. 2025, what are we going to have? 2025. 2025. It is now the balance. The balance carried down in 2024 becomes the balance brought down in 2025. That is what we need to do. So if the pattern will continue, why can't you just do it up to the last point here? If the pattern will continue. Now, depreciation rate is not changing. It is on reducing balance method, yes, but it is 30% all through. I think you can remember the other question which you were doing. We were told it was decreasing, it was being depreciated. The first year it was 35%, the second year 30%, 25, 15, 10, 5, 0. Here, the 30% is constant. Whatever is changing is basically now the cost. So for 2025, I will come to my depreciation in 2024. I've already inserted the formula. It is 30% of the cost for that particular year. If that formula is already inserted, why can't I just autofill? Why can't I just autofill to the very last point? Then I also know very well that net book value is equivalent to cost minus depreciation. If I look at my 70 million, I was getting it by taking cost minus depreciation. That formula is there. Why can't I just autofill all through to get everything? Why can't I just autofill all through to get everything correct? So I've now gotten that my net book value, I've gotten my depreciation for 2024 to 2028. Are these things really making sense to somebody? Are these things really making sense to somebody? Are they really making sense to somebody in this meeting? Somebody who has joined discussion group, somebody who has attended one of the discussion groups. Are they really making sense to you? Repeat on autofill. Autofill here. Sasa hapa ndio is the simplest part. Let's have it here. Depreciation rate is 30%, equal to 30% multiplied by fixed or the cost. I'm getting 30. So this formula of 30, it is the same 30% of the figure that is here. So if I just come here and autofill, of course, at first point, it's going to give me 0. But if I insert 7,000 here, you're able to see it will take 30% of 7,000. If I insert 30 here, it will take 30% of the 30 to give me 9. That is what is going on there. So once I've autofilled, the only thing that is missing for me to get the values is the cost here. How do I get net book value? Net book value, we have said, is equivalent to 100 million minus 30 million to give me net book value. So this net book value in 2024 becomes now the cost in 2025. So somebody may decide to come up here and just write 70 million for them to get this. Another person may say, because this 70 million is what is down here, this one here, what will I do? I'll just come and say equal to the 70 that is down there. So that when I now again autofill, it will pick the value that is down here. For example, in 2028, I expect it to refer to a value in 2027, net book value. Let me try to edit the formula. You can see it is referring to what is here. So whatever is remaining is just for me to insert that figure there. If I just decide and put 560, you'll be able to see this 560 being transferred to 2028. So that is basically what I'm doing. Now down here, the net book value, we said it is cost minus depreciation. That's what my formula says. So another person will come, okay, it is cost minus depreciation. I check this minus this one here. Then again, they come is equal to this minus this one here. So because you know what is supposed to be done, you simply set your formula at what point? At this point. Once it is set and it's going to continue all through, you just come here and autofill, and then you will arrive at those figures. You will arrive at those figures. So I believe it is now clear. So that's what we are going. That is what we are going to have. That is what we are going to have there. That's what we are going to have there. Then let's come to this point. Let's come to this point here. So what we are looking for is the capital allowances. Of course, this one was for demonstration. So we now get the real capital allowances, which is equivalent to what we have here. So just refer to those values there to the very last point. Refer to those values to the very last point. Okay, then we now come to this particular point. We now come to this particular point. Okay, somebody is telling us that the value for last year, that is 2028 or fifth year, is supposed to be now the difference. We get these ones here to give us 75,990,000. So the difference between this initial cost of 100 million and the summation is what we should have in year 5. Okay, that's what should be there. But have we been told that the life of this investment, the life of this asset is 5 years? Have we been told anything of that kind? 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 The depreciation tax shield is a different approach. If you take the depreciation tax shield, then you don't need to get this one here. You don't need to come and less capital allowances. No, you just get your profit before capital allowances, you get tax expense, then you add back the depreciation tax shield. And I said, if that one will give you a challenge, why can't you take your depreciation, you deduct, you get your profit before tax, get the tax expense, then you add back the depreciation to change now the net profit to cash flows. Okay, so at this point, after getting the capital allowances, we can now get our profit before tax. Profit before tax. So the profit before tax is equivalent to profit before capital allowances minus capital allowances. For us to get now the profit before tax. And then we now subject it to tax expense of what percent? Tax expense. What was the tax rate? What was the tax rate? What was the tax rate? Somebody to help me there. Tax rate, somebody to give us the tax rate. Capital allowances. Somebody is not understanding something. What is it that you are not getting? Is it the depreciation rate? Is it the depreciation rate? Is it the depreciation rate or the net book value? Is it the depreciation rate or the net book value? Okay, net book value. Net book value. How do we get net book value? Net book value is the, okay, maybe you have this knowledge of cost minus accumulated depreciation. Maybe. So is it that you are confusing it with this cost minus accumulated depreciation? Is it that you are confusing it with this concept, cost minus accumulated depreciation? Is this what is giving you the confusion between the two? We have said that fixed costs is 100,000 or million, the fixed asset, the cost, the fixed cost. And remember, I've said it is not, we have not been told anywhere that the lifespan of this particular asset is 5 years. We have not been told. If you are told that the lifespan of this particular asset is 5 years, then we expected that the last year, there's nothing that's going to remain. So the last year could have been all the amount that has been depreciated up to 2027, which is giving us a total of 75,990,000. Then the initial cost of this asset was 100 million. So it means the depreciation in this year, in 2028, could have been this one here, 100 million minus 75,990 million to give us 24,000. So this 24,010 is what we could have inserted here, to be the depreciation, so that net book value at the end of the asset life, at the end of the lifespan of this asset, we have an end net book value of NPV of what? Of 0. The examiner has not mentioned that the lifespan of the asset is 5 years. It is the project life that is 5 years. And because the project life is 5 years, it means we expect a net book value, which the net book value we are going to compare with the proceeds on disposal. Proceeds on disposal of the asset, and then we see whether we have capital gain or loss. If you are told that the lifespan of this asset is 5 years, our net book value automatically could have been 0. And then we compare with the proceeds if it was disposed. They have not mentioned the lifespan of the asset to be 5 years. No, it is the project life that is 5 years. So am I making sense to somebody? Are these things really making sense now? Are they now making sense to somebody here? Good, so let's proceed. So once you have this, we now have our profit before tax. The tax rate you've told me is 30%. Is 30% of the profit before tax. So I will get my tax. So the profit after tax, So let's all get profit after tax. I just want you to give me the profit after tax of 2026. Profit after tax of 2026, somebody? Profit after tax of 2026, not 2025. I just want the value for 2026. Profit after tax of 2026, that's what I want to see. And then I do it, we compare. Once we get that they're the same, then automatically that is okay. What do we have? 25,80,000. So let me now calculate and then we compare. Let me now calculate and then we compare. Of 2026, 25,80. So automatically whatever you have is correct. That is profit after tax. So that is the normal profit that's how you normally prepare your income statement. But remember, we are interested in net cash flows. In cash flows, not the net income. No, we are interested in cash flows. So for us to convert this to cash flows, what do we do? So first of all, we add back the depreciation. Add back the depreciation or capital allowances. Depreciation that was deducted for you to get tax benefit. That depreciation is what we are going to add back. So you can refer to the depreciation that was down here, or you just pick the values that are up here, or you refer to what you have up here. You refer to what you have up there. Then, after adding back depreciation, what next are you going to do? What next are we going to do? So we have now operating cash flows. Operating cash flows. So operating cash flows is the summation between the profit after tax, and then we add back the depreciation. So I will simply come and say summation. I just add the two and then autofill. So I want you to give me the value for 2028. Operating cash flows for 2028. What are we having? Yes, we are getting to that point. Don't worry. We've not said the net cash flows. We're just talking about operating cash flows. 2028. Operating cash flows for 2028. Operating cash flows for 2028. Let us do it together now. I just come and do it this way. So I've confirmed that whatever you are giving me there is correct. So we have operating cash flows. So after getting operating cash flows, we now bring in the element of working. We now bring in the element of working capital. We bring in the element of working capital. The working capital. What did they say will be the working capital? Working capital. Initial working capital in period. Initial working capital in period what? In period 0, 2023. Initial working capital in period 0, which is 2023. We are going to have 15 million. The 15 million we are being told there is a negative because it is in period 0. That is the working capital. The initial, of course, it's a negative. Let me just make it to be a negative so that somebody can see it clearly. Let me just do away the dollar. I believe yours does not have the symbol, the dollar sign there, for just demonstration, but I believe you are now able to see the negative. It is a negative. It is a negative. It is a negative. So that is working capital in period 0. What are they telling us about this working capital? The working capital will be recovered at the end of the project. Okay, that one comes last, but let's look at it from this point. The inflation additional information number 1. The inflation rate applies to revenues, direct cost, incremental fixed cost, and working capital. So what is the inflation rate? 5%. Our working capital in period 0 is 15 million. This working capital will increase by what percent? By 5%. Working capital imetoka wapi? Mercy. Mercy, I want you to read for us this one, if it is possible. Just read it, even though we may not be able to hear you. I want you to read for me this item here. Row number 13. Row number 13. Is it resembling what we are actually having here as 15 million? Mercy tusaidie hapo. Mercy, help us there. Is it representing what we are actually using? Good. So that question is answered. Let's get to this point now. The working capital is also increasing at the same inflation rate of what? Of 5%. Now my question is, if I increase the initial working capital is 15 million initial. When it is increased, it's going to be increased by 5%. It's going to be increased by 5%. So what's the 5%? And I want you to keep track of what we've been doing. 5% multiplied by this. So I want to ask you a very simple question. It means the new or the total working capital that shall have been spent up to that particular point will be 15,750. So my question is, what am I going to insert in 2024? Is it the increase or the new value or the cumulative? Remember, this now is what we call now cumulative. I want to use that term because it resembles what we did in the other question. Are we going to take the increase? So this 5% is the increase. Are we going to take the increase or the cumulative cash working capital? Are we taking the cumulative figure? Are we taking the cumulative figure? Are we taking the cumulative figure? Are we taking the cumulative figure or the increase? If you've been going through the videos that we've been posting there's a time that we covered this and we said we don't take the cumulative figure. For working capital, we take the increase. We take the increase. So if you are taking the increase, it is very, very simple. Here, we'll simply come and say equal to. We'll simply come and say equal to the increase. That increase is 5% multiplied by the working capital in period 0. By the working capital in period 0. Then I come at this point. So what are we going to have? We are increasing that by 5%. So the initial outlay here. So this one here, we are increasing it by 5%. So the new value of our working capital, that's just at 2024. Now going forward, it will be 5% of this cash flow or working capital in 2024. We're now going to take 5% of this. 5% of that, we are going to take the increase. We are going to take the increase. We are going to take the increase, which we are able to see, as 750,000. So can someone give us, before I get you the value there, I want you to give me the value for 2025. The value for 2025. 2025. What will we have? 2025. Apples house. 2025, what will we have? 2025, what will we have? 2025. 2025, what will we have? 2025, we are going to have 1.05. Then you multiply by this. Then you multiply by that, and then you do it not to 2028. No, not to 2028. 2028, because we said in 2028, we are going to recover the working capital that was spent. And that amount which we are going to recover is a cash inflow. We add it back. We add it back. So once we have been able to get the working capital that was spent all through to 2027, can someone give us the amount we are going to recover in 2028? Someone to post for us the amount we are going to recover in 2028. The amount we are going to recover in 2028. The amount you are going to recover in 2028. The amount we are recovering is the summation of the total working capital that has been spent. The amount we are recovering in 2028 is equivalent to the summation of all these, which is 18,232,594. 18,232,594 equal to summation. Just have it there, summation. And of course, they are in negative, but I expect to have a positive because I'm recovering that amount. Sorry. I'm recovering the amount, so I'm going to recover them up to that point. So this is what we are going to recover. Of course, this is in a positive form. Good. Then, after dealing with the working capital, we have it there. Of course, this sounds to be like the terminal cash flow, that working capital at the end of the project, which you are going to recover. The working capital, the first figure was 750,000. Then we increase now the 750, not 15, 750. No. Because somebody may say, this one here, we also take now the increase equal to 5%, multiplied by this. 5% multiplied by that. Are you able to see this? We only take the increase, not cumulative. So what will be our cumulative down here? I want you to understand the concept. Cumulative will now be the summation of the cumulative of the previous period plus the increase. Then I again come for the increase, 5% equal to 5% of the cumulative amount. Tunapata ngapi? 826, 875. Is it not the same as what I have here? We only check the increase, not cumulative. We only take the increase, not cumulative. We only take the increase, not cumulative. So I think it is now making sense. So another person may say, okay, which is equal to this, I multiply by 5%. So that increase is what I have here. Then going forward, I just come and say this, I now multiply by 1.05 because it is basically increasing by 5%. So those are the figures that I'm having here. So if I add these ones here plus the initial working capital, then I will get the total. That total is what I recover in the last period. I've indicated negatives here to mean they are cash outflows. But then in the last year, I'm going to recover all of them. That's why I have it here now as a positive number. So I believe my people are now able to understand that. My people are now able to understand that. What will be wrong? Okay, I think that has been explained. After working capital, there is something that we need to take care of. Do we have proceeds on disposal? Proceeds on disposal, do we have anything of that kind? Now we are trying to look for the terminal cash flows. We have something here, row number 12, before tax residual value. Before tax residual value. So before tax residual value is what we bring down here. Before tax residual value is what we bring here. We are told it is 20 what? It is 20 million. It is one of the terminal cash flows that we are going to have here. Before tax residual value. Before tax residual value is given there as 20 million. Of course, we are adding it. So after getting the before tax residual value as one of the terminal cash flows, we now look for our net book value. Compare it with, so proceeds on disposal or before tax residual value, what do we have? What do we have there? We have been given 20. We have been given 20 million. We have been given 20 million. How about the net book value of this asset as at the end of the project life? So here, remember, it is not the end of the asset life, it is the end of the project life. So at the end of the project life in 2028, what are we going to have as the capital gain? That's why we are doing all this. So proceeds on disposal is 20 million. Can we now compare this 20 million? Can we now compare this 20 million with what we are going to receive with the net book value of our asset? So can someone give me the net book value of the asset? Net book value, and we all know that net book value is equivalent. Net book value is equivalent to cost minus accumulated depreciation. Cost minus accumulated depreciation. So do we have the cost? The cost is this one here. At the initial stage, 100 million. Accumulated depreciation is the summation of the depreciations for the entire project life, which is 193,000. So can we now have our net book value, which will be equivalent? So just get the summation of these depreciations. Just get the summation of the depreciations there. We have 193,000. But then the cost of the asset at this stage. The cost of the asset at this stage is what? The cost of the asset at this stage was equivalent to 100. So we are going to have 100,000 minus the summation of the depreciations, that is the accumulated depreciations. All of them, we are going to have what? 16,807. I've used that long approach to help you know how to get that value directly. So is this value not the same as what we have here? No need of calculating the accumulated depreciation. You already have a column for net book value. So at the end of the project life, which is 2028, your net book value is basically this figure here. So just come and do what? Just come and pick that. Just come and pick that. Now, the net book value that I expect, if I'm supposed to sell this asset at the end of 2028, then I should be selling it at 16,807. But when this asset was sold, it was sold at 20 million. So did we make a profit or a loss? We disposed it at 20 million, yet the net book value at the same time was 16,807. Was it a gain or a loss? Was it a gain or a loss? Was it a gain or a loss? We take the proceeds on disposal less net book value. So if you get a positive figure, it is capital gain. If you get a negative figure, it is capital loss. The moment you have capital gain or capital loss, then somebody asked me a very important question here, additional information number 4. Tax will be applied on the gain or loss on disposal of the asset. So we now come down here and ask ourselves. Capital gain is 3193. We are told that we have to pay tax on capital gain. Tax on capital gain will be at what rate? The tax rate which was given to us is still 30%. Is still 30% of what? Is still 30% of the capital gain. So what do we have? This is a tax expense. It is a tax expense that you are going to deduct. But if this capital gain was a capital loss, it could have been benefit. The tax benefit that these people could have gotten because they are having a capital loss. So we could have added that tax benefit. But because this again, they have to pay tax. It is an expense. So we now come up here and say tax on capital gain. Tax on capital gain of what amount? Tax on capital gain. Remember, it is an expense. So we just negate it, just insert that negative there to make it work for us. Then I just make the format the same here. So it is a negative. Now, up to that point, is there something that I'm leaving out, which we need to include for us now to arrive at the net cash flows? The net cash flows. Is there something that I'm leaving out for me to be able to arrive at the net cash flows? Yes. The investment amount, the cost of investment at period 0. The cost of investment at period 0, I was supposed to have it. I was supposed to have it here. So I can bring this. I can bring that there. I can bring it there. And of course, I know it is a negative. It is in period 0. It is in period 0. So am I able to get my net cash flows? My net cash flows will be equivalent to, operating cash flows. Of course, there is nothing that I've inserted up here, but for this column here, you can just get the summation of all of them. All of this column here, you deal with it. If there's anything that you incurred at the beginning or at period 0, you get their summation there for you to get the initial outlay. So this is the initial outlay in period 0. About these other ones, we are going to get the operating cash flows minus, of course, it is already in negative form. So we just put summation formula to make it now get for us the summation. And then I do that to the very last point. Then I do that to the very last point of my project. So that is the net cash flows under expected scenario. Under expected. What about the capital gain itself? No, we are not going to bring it there. So that is what we have. Yes, it is the sales proceeds. It is the sales proceeds. It is the sales proceeds. So we have now net cash flows. We are only lacking something here called cost of capital. But in these questions, they have not used that term. What are they saying? Weighted average cost of capital is given to us in additional information number. Weighted average cost of capital for the company, 15%. Weighted average cost of capital is 15%. If you already have that, do you think it is now possible for us to get net present value and then internal rate of return. At this point, I think you are now okay. So long as you have the net cash flows, you cannot be defeated. You cannot be defeated to calculate. You cannot manage to say that you are not able to calculate NPV. So I want you to get me the NPV. NPV equal to net present value. Of course, here we are not considering what time frame. The interval between the dates is not considered because we don't have specific dates. So we are going to use what we call net present value formula. Weighted average cost of capital is the rate. Values we pick from year 1 to year 5. Then close the bracket. We are supposed to less initial outlay, which is already in a negative form. So what do? Add. Then I get that. So this is the net present value, and just say the project is viable. The project is viable. Internal rate of return. This is what we did yesterday. So at this point, I expect everyone to be at par. Values, I get these ones here, including the initial outlay. So internal rate of return, let me make it as a percentage, maybe to 2 decimal or 3 decimal places. So that is the internal rate of return. That is the internal rate of return. So I just want you to confirm to me that your net present value amount is 21,902,673. Are we having that? Are we having that? 73 million imetoka wapi? Remember, here in 2028, we are dealing with the terminal cash flows. If you are really watching the videos that we have been posting there, I want you to mention for me some of the items. Here, let's just have this. Let's just have this. Let's just have it this somewhere here. Terminal cash flows, as per our previous discussion. Terminal cash flows. Can you just mention some of the items that we talked about? Terminal cash flows. Terminal cash flows. Terminal cash flows. So the terminal cash flows, we have working capital recovered. Working capital recovered. We have residual value. Or salvage or disposal amount. Any other terminal cash flow item? So we have now tax benefit or tax saving. Tax saving becomes terminal cash inflow if they add capital or loss on the amount that they are going to receive when they dispose of their asset compared with the net book value. If it is a negative, that is net book value is more than what they received, then that capital loss results to tax saving, and that tax saving becomes what we call terminal cash flow. In this case, they are disposing it at 20, net book value is 16. That's a capital gain. So what they are getting here is tax on capital gain. It is not tax saving, it is tax expense. So we now eliminate this as per our question. Working capital recovered. We said the working capital that was spent from the first year to 2027 or to 4th year will be recovered in the 5th year. Our working capital, the first one is 15, 750, 785, 826, 868 for the 4 years. or the 5 of them from year 0 to year 4. So this is the summation. We have it down here, 18 to 32, 594. All this we are going to recover in year 5. It becomes our terminal cash inflow. 18 to 32, 594. 18 to 32, 594. I bring it here. This is what we are recovering. This is what we are recovering. And then we bring in now the residual or disposal amount of 20 million. Of course, the tax, we all know that is now an expense, but we can bring it here as outflow. So let's say the tax on capital gain. It is a terminal, but now outflow we indicate as a negative here. This is what I have. If I indicate it as a negative there, let me indicate it as a negative for you to be able to see. So what is now our total terminal cash flow? Our total terminal cash flow is 37,274,694. Let's say all these things that we've added here before tax residual value, profit after tax, this is working capital before tax residual value, this is it. Then, so these are the things after bringing in the working capital that you're going to recover, the one that was an expense. So let's just have this one as 0. There is no working capital that was spent in 2028. So let's now do away with all this. Let's just do away with all these things here. And then we just use a simple term, terminal cash flows. Terminal cash flows are coming in year 5, the last year of the project. We've calculated all of them and we have the figure down here. Sorry, we are referring to the ones that were given up there. So we add the summation of these ones here. Let me just check it. This is the amount. This is the amount. Sorry, that is 18 to 32, 594. 18 to 32, 594. So let's have it there, and then residual value is 20 million. So let's have it that way. So the terminal cash flow here, we just pick this value down here. We just pick that value. Down there. That is what we have. Is there anything that is missing? Something that we are leaving out? To make us get the same answer? Something that you are leaving out? Something that we are leaving out? Something that you are leaving out? Is there something that we are leaving out? Or we deleted the initial cost here, which is supposed to be part of this. So after terminal cash flow, of course, the initial cost, you can even bring it up here. The initial, just say initial. Just say initial cost, and we've already calculated it. We know it is 100 million. 100 million. So the summation, you add all this. Then this is what you are going to have. So as you can see, nothing has changed. So what we are doing is just for us to get our marks. You can say you come at this point, the working capital recovered, you have a wrong figure. Residual value, you have a correct figure because you're just going and picking that. So for you not to get like 0, remember, if you carry this and it's a wrong figure, you are going to get 0. Why can't you split those items here so that instead of losing all those marks, at least you have one tick for the residual value? And let's say you're going to lose the marks for working capital recovered. Of course, tax on capital gain also maybe you're going to miss. So why can't you spread the risk? The examiner will give you 2 points for this if you split them, other than getting 0 for something that you could have gotten. So to maximize your marks, if you can split them, split. If you will get the marks for the one that you are sure of, and then maybe you get a 0 for what you are not sure of, and then you proceed. So just try to maximize the marks. Just how do we arrive at the negative working capital? I don't understand. I don't understand your question. The net present value that I have, this is it. That's the net present value that I have. Okay, so now I just want us to understand. So let me do away. Let me do away with this one here. Let me take back now. Let's now spread the risk. Let's spread the risk. Let's get our, let's get our terminal cash flows. Let's get back to our terminal cash flows. Let's not merge the figures. Let's have them one by one. Let's have them indicated there. Let's have them indicated there. So that is what we have. Everything is now complete. Everything is now complete. So I want to now go to the second scenario. And what was the second scenario? What was the second scenario? Optimistic scenario. So I want to teach you tips on how to maximize. Remember, you've just seen we are taking almost 2 hours to set the expected. It means it is possible that you will take 3 hours to do the 3 scenarios, yet you are required to do 3 questions from this section. So once you've been able to set everything here with the references that we are doing, you just come up here, highlight this, just have everything copied. Copy everything that you are using there. That is what you have. Control C, copy that, and then you come to this space. Control V. Control V, then you say this one is going to be optimistic. Optimistic. So just copy and paste that optimistic. So once you've done that, come down here and check something that is very interesting. Is the figure still correct the way it was? Is it still correct? So our NPV is still correct the way it was given there. So now you come to this part here. First of all, the initial investment. What are they telling us under optimistic? We are reducing it by 20%. So it means the optimistic will be 80% of expected. Is it? Optimistic is less by 20%. Expected was 100 in 2024. But then optimistic is 20% less. That is 80% of expected. So I just come here. In 2024, under optimistic, it is the investment year. Where is our investment? So any place that you are using the investment, it is equivalent to that. Then you multiply by 80% because it is being reduced by it is being reduced by 20%. So that's the new cost of investment. Then I come down here, anywhere that I was having cost of investment, it is going to be 80. So cost of investment is this. Now the beginning cost is this one here, depreciation. The formula is still set. Nothing has changed. So I just change them one by one. So I've now changed what? Cost of investment. How about working capital? Or let me follow this order. Before tax residual value, I'm now told it is not 20 million. It is more than that by 10%. It has increased by 10%. So let me come to that place where I was inserting the before tax residual value. Before tax residual value, it was 20, but I'm told it is going to increase by 10%, 1.1. It is increasing by 10%. Then I come down here where I was having it. Remember down where I was getting the capital gain or loss. Here, I'm now referring to this. This is it. This is the amount. Net book value accumulated, it has already picked whatever is up here. I've known I have capital gain of this, capital gain of this, and then the tax expense. It has already been reflected up here as an expense. So that one is how, that's how we change the before tax residual value, initial investment, initial working capital. What has happened? It is being reduced by 5%. So it means it will be 95% of this figure. 95% of that figure. I just come here very fast. It is 95% of that initial figure. It is 95% of that. It is 95% of that. It is 95%. Anywhere that I was using the working capital, I must ensure that it's going to change. The first one, the initial one, it is 95% of that. There's a question here. What if we use the choose function? Good. That one also we can use, but I want to advise you in this manner. If choose function will make you lose marks for something that is very simple, then forget about it. If you know how to use it perfectly and it will save on your time, please adopt it. Because what they're going to look for is, have you written the correct answer? For example, the residual value that you just transfer, you don't tell me that you are going to afford to lose marks because of using the choose function, just because you don't understand it perfectly. Just do these things manually. Post them. Post the transactions, and then you'll get your marks at the end of the day. But then I will also expose you to that choose function, and then you now choose between that or this other method. Good. So we are now through with the initial working capital. What are they telling us? What are they telling us with the revenues? The revenue in 2024 will increase by 10%. So it is not going to be 140, no. It will be 140, then you multiply by, it is increasing by 10%, so 1.1. So the new revenue is 154. So for 2024, here, 2025, the other one was increasing by 5%. We do not know the increase here. That one we are going to get from additional information. Direct costs in 2024 decreasing by 20%. Direct costs here is decreasing by 20%, so will be 80%. Will be 80% of that. Will be 80% of that. How about incremental fixed costs? If we have it, incremental fixed cost decreasing by 10%. So it is going to be 90. Incremental fixed costs. Incremental fixed cost will be 90% of this because it is decreasing by 10%. Then capital allowances, the rate has changed. The rate has remained constant, but now the amount to be depreciated has changed. So automatically it has picked that from our formula there. The tax expense is 30% of this. Depreciation, we are adding whatever is already given there. Nothing is to, we are going to adjust nothing there. Operating cash flow, you already set the formula. Everything is perfect there. So let's see. Up to this point, we've captured those items. But remember, there are some things under additional information that we need to take care of. There are some things under additional information that we need to take care of. So additional information number one, the inflation rate applies to revenue, the direct cost, incremental cost, capital allowances not applicable. Then direct cost, incremental costs, working capital. Working capital. So just look at it. Now, under optimistic, the inflation rate is 3%, not 5%. It is what? 3%. So I just come to this point here. Revenue is being affected by 3%, so it's going to be 103. That is the increase. That is what I need to adjust there. That is what I need to adjust there. Direct costs is increasing by 3%, so it's going to be 103%. That is what I need to do. Then incremental fixed cost by 3%. That is what I need to do. Then capital allowances, it's already calculated down here for me because I've already inserted the initial fixed cost. So that one I just skip. Then tax expense, 30% of this, nothing is supposed to be adjusted there. I just move down to working capital, which is also being affected with the same rate of 3%. So I just come here. Remember this one here, we've already adjusted for 2024. So going forward in 2025, it is increasing by 3%. That's what I adjust there, 3%. That is the only thing I'm going to adjust there. Do it to this point, and automatically it will get the summation of these ones here. Do it to 3%. Of course, this one here, there's something that I've just done wrongly. So this one is 3%, and this one here was now 103. That one was 103. You just adjust it to this point. Then automatically it gives you the summation. Cost of investment, you can see it has changed. It has changed. Net cash flow, so initial outlay is this. Weighted average cost of capital does not change. Net present value is now going to change because of the difference in cash inflows or the net cash flows. Internal rate of return, that is what we have. That is what we have now. So maybe something that we are leaving out. Something that we are leaving out. Something that we are leaving out. Something that we are leaving out is what now somebody should tell me. Then we see something that we are leaving out. Something that we are leaving out. So you're able to see our net present value is now 109,763,651. Internal rate of return is this one here. That is the simplest way. Once you set the first one, these other things are just going to be a walkover. These other things are just going to be, or is that when I paste from expected to optimistic, the figures change? Because you locked. If you used the locking that I said, you should maybe see on how to use it, then automatically the figures will keep on changing. capital allowance. So if the way they are saying not applicable, that rate remains constant. That rate, we are going to depreciate this asset at 30% on reducing balance basis. On reducing balance basis, that is what we are going to apply all through for the three options. That's what we are going to apply for the three options. For the three options. So my good people, I want you to even create time by yourself to do this. So to just save you and give you powers to proceed and do that, why can't we just have this here? I know we are tired, but let's just have this. Let's just have this up here. The pessimistic case, we've seen the things that we are changing. Revenue, we are told that is increasing by 30%, so 1.3. It is increasing by 1.3. But then 1.3 initial investment. So the initial investment is what is increasing by 30%. So we just come here where we have our initial investment here. The one that is here is increasing by 30%. So times 1.3. It changes, it should reflect. So the purchase cost we are going to have 130,000 million. 130 million. Automatically it moves down here. Everything is adjusted down here. About revenue, or let's follow this order. Before tax, residual value is reducing by 10% of the expected. So it will be 90. It will be 90 of what is given there. So we just come up here. Before tax, it is 90 or 0.9. So we have 90% or 0.9. You get this. Automatically, it is transferred. It is transferred down here. Net book value already is all given down here. So this one, we now have capital, not capital gain. We have capital loss. And what did we say about the capital loss? How are we going to treat the capital loss? How are we going to treat the capital loss? We are now going to have what we call tax saving. We are going to have tax saving. So the tax saving here will be added. We are not going to subtract. And automatically you can see tax on capital gain, it is tax saving. We are going to add it. We are going to add it. Already just changed to a positive number. Very simple. Then the next thing, given initial working capital is going to reduce. Initial working capital will be increasing by 5%. So 105. 105. So just come to this part here, look for your working capital. It is going to increase, so it's going to be 105%. 105%. Any other place that we use the initial working capital down here, it has changed that. Once that is changed, of course, we are going to look at the inflation rate to effect other changes. Then we have revenues will reduce by 15%. So the revenue in this year will reduce by 15%. That means it's going to be 0.4 times 85%. Times 85%. Then after revenue, what are they telling us? Direct cost will increase by 20%. So direct cost here will increase by 20%. That is 120%. 120%. How about incremental fixed cost? Is it going to increase or decrease? Incremental fixed cost is going to increase by 10%. So that is 110% or 1.1. 110% or 1.1. That is what we have there before we move to additional information. Before we move to additional information. If you paste, you just copy and paste like that with the formulas. You don't paste values. You don't paste values. Then, now we've worked out all the items that are given up here. What we are going to do now to come to additional information. Under additional information, inflation rate is affecting revenue, direct cost, incremental fixed cost, and working capital. But now, whatever has changed is, it is not 3% under pessimistic, it is 8%. Very interesting. I just come up here to my revenue. Here, I know very well this one, it is now going to be 10. It is going to be 108. That is what I need to do. Just as simple as such. I'm through with the revenue. Direct cost, I come here. Just change this to 108. Change it to 8. Autofill. Come to incremental fixed cost. Change this 3 to 8. Autofill. Then you know very well that now the working capital has got this issue. Working capital, first of all, we get the increase, which is 8. Then from there, now we come to this point and put it 1.08 of the previous year's value. Do it up to year 4, then automatically it gets the summation of these ones here. You'd already set that profit before this is already given down here. Tax saving, because it is now capital loss, it is already given up here. Then you proceed. Initial outlay, you are told it is going to increase by 30% from 100 million. If you add 30% of that, you're going to get 30 million. So the total will be 130 million. That is what we have. You confirm to me that whatever I have here as the NPV is the same as what you have. And of course, let me just put the format, then you see, we have a negative NPV. So what are we going to say here? Not viable, not viable, not viable, not viable. So this is what was given to you in April for you to get your 20 marks. As we've seen, the only challenge was to set up the expected items. Once you set up the expected items, this one's here now becomes very, very simple. Set the expected, then other things will follow. Set expected, then other things will follow. Set the example, then other things will follow. If you did these things the way I was doing them, without locking, remember I've not mentioned anything to do with the locking the cell today. If you did these things without locking, just look at what I have. I did not lock any cell. You just come here, highlight this part here, highlight it to the very last point, Control C. If I go to even a new worksheet here, then I say Control V. Then I say Control V. I just expand. I just expand my cells, and I will see everything displayed. The formula, nothing has changed. Look at my NPV, nothing has changed. So it is now upon you to come up here. You are told it's going to increase maybe. It is going to increase maybe by 30%. That is what you do. That is what you do. I've copied it, pasted it this side with the formulas intact. There is nothing that I'm getting 0. If you locked the cells, that's where the problem is. If you locked the cells, that's where the problem is. So this video, the capital allowances, they are changing because, remember, they depend on what? Look at what the capital allowances depend on. Look at what the capital allowances depends on. Here, our capital allowances depends on this value here, the fixed cost. 30% of 100 million is 30. If I come to this point here, 30% of 80 million is 24. So it is changing because these values here are changing, but not the rate. The rate is constant. The rate is constant. The rate is constant. So I believe that is clear.